6.1%, pretty much in line with expectations, and it's a robust number that we're looking at here.
It's not too bad at all. Bear in mind, all these numbers are coming off a relatively low base. I mean, we had seen the recovery in retail sales occur in the fourth quarter of last year, but the base was still relatively low. So, you know, I think as we go deeper into next year, the number will go down, but it won't necessarily mean that.
But it's better than what we saw during the World Cup.
Yes, I mean, World Cup that was running at, well, it got up to about 8%.
8%, yeah.
So it's slightly off on that. Again, the 8% was influenced by the base because at that stage we really hadn't had much of a recovery in 2009.
Because we're heading into Christmas period now, so we'll get those numbers in a couple of months' time. Would you expect any significant pickup in that Christmas spending?
Yeah, it's a mixed bag at the moment because people who've got jobs are clearly benefiting from lower interest rates. They've managed to whittle away a bit of their debt, and yeah, I think they'll spend reasonably robustly over the Christmas period. The problem, of course, is that we haven't seen a pickup in employment. As a matter of fact, we've actually seen further deterioration on that side. So that's what's holding back the consumer picture. If we had some improvement on the employment side, I think you know, the retail side would have actually been flying a lot more than it is at the moment.
What about interest rate cuts? And looking at the next meeting, we've obviously had we had many interest rate cuts so far, which obviously is going to give consumers more disposable income. But the debt to GDP ratios that we're looking at in South Africa relatively high, and also debt to disposable income is still a key issue.
That's right, and credit growth, as we know, is very, very weak at this point. So it's not really actually adding to consumer purchasing power at this point. I think Reserve Bank will look very closely at what happens over Christmas from a demand side point of view. I don't think they've got anything particularly to fear there from cutting interest rates. And then the other big factor will be the currency. You know, if the rand strengthens further over the Christmas period and we hit January or March and we've got a much stronger rand, then I think they would consider another interest rate cut.
And of course, how would you factor in the inflation expectations survey that came out yesterday that really shows benign inflation expectations going into next year?
Well, that certainly helps, although it does show, you know, a slightly higher path than where we're at the moment, but I think that again is really on base considerations and so forth. So I think they're comfortable on the inflation side. However, we know inflation can change very quickly. You know, the oil price can go to $120.
And it's getting there quite rapidly, isn't it?
Yeah. And, you know, by the same token, the rand can actually weaken very quickly. So, you know, that they have to take with a pinch of salt. But I think really what they'll take a lot of guidance through this cycle will be how much demand is picking up and how much of that is credit-based. I think they'll be quite sensitive to that.
Dennis, I mean, looking at the unemployment rate, and you said that of course being one of the big issues because that scenario hasn't changed. Do you think that we perhaps could hear of more retrenchments down the line going into 2011? I mean, we just saw Standard Bank rolling out its last set of retrenchments. At least we hope it's the last set.
Yeah, look, that's been one of the very disappointing things is that I must admit I thought second half of this year we'd start to see some stabilization in the employment picture and maybe some pickup. But clearly a lot of companies are looking at the situation and saying, well, you know, what is the new normal, and you know, what can we really expect going forward, particularly those that have got an export focus on Europe. You know, so I'm hoping that the retrenchments will cease as we get into 2011. But the pickup's going to be slow, and I think that not only applies to South Africa, it applies generally across the globe.
Getting the Reserve Bank's quarterly bulletin out tomorrow, and that's going to give us a snapshot of the South African economy in the third quarter. Household consumption expenditure, that's going to be in there. Debt to GDP, debt to household income. Also the current account deficit. What are you going to be looking for specifically in that bulletin? Yeah,
look, clearly the really new news will be on the current account side, you know, I think clearly we're hoping that there won't be any sort of deterioration or significant deterioration coming through on that side. But I don't think it will be market changing in the sense that you know, the rand will swing down if we see a widening in the current account deficit. I think it will be of more interest to economists as they set in their forecasts for 2011 than necessarily the market. I don't think there's much that's market changing in there. The really sensitive one would have been the GDP number, but we actually know from an output point of view what the GDP figure is going to actually be. And then it will be just to see how the Reserve Bank patches up the expenditure number to get to the same sort of 2.6% number. So we would expect, obviously, debt to income to come down somewhat.
Because it's sitting at around 78%.
78 at the moment. And I think what's happened there is that despite the fact that disposable income has been going up, there have been some definitional changes in the household debt numbers. Some additional figures have actually been added to it, so that's distorted it to some degree. But we would expect, given that credit growth remains very, very weak and certainly below what's happening to disposable income, that over the next few quarters you will start to see that heading down to the lower 70s, which will still be relatively high.
What figure would you be comfortable with for that?
Well, I think the problem with South Africa is you've got very volatile interest rates. We come from a volatile interest rate situation, and generally interest rates are typically fairly much higher than what you see in Australia and those sort of countries. So a ceiling on household debt, I think, is probably about 80%. But at this stage of the cycle, you would prefer to see it around about 65, somewhere of that sort of order, to give some sort of headroom growth into the next upswing. So it really actually has been slow to come down. And
what about the spending power of South Africans going forward? Do you think we could see retail sales picking up to the likes of 15 and 16% as we saw during the heyday a few years ago?
No, I think this cycle is going to be a lot more modest. First of all, you're starting off with a higher debt base, so the ability to pick up extra debt is going to be limited. And then the other big factor is employment, and I think employment growth in this cycle over the next 2-3 years is going to be more modest than we saw in the previous cycle, and that was not all that exciting. But you know, the key, if we manage to sort out the employment issue, that is the big kicker that could come through on the disposable income and hence the retail sales.
Do you think that government could get it right, given the fact that they've got a growth plan in place and they, of course, are looking for new strategies to ensure that we do see very close to 7% growth, never mind the 2.5–3% that we're talking about now? Yeah,
look, there's some things in the growth plan that I think that could help, but I think that the constraints in the really short term would remain things like the electricity and transport infrastructure, and those are not going to be addressed very quickly. And then over the longer term, obviously the big constraint is education and skills. And there are some elements in this, but I must admit I would have liked to have seen in the plan something that would have actually really made it a lot easier for business to actually hire unskilled workers, the people that are actually form that 25% unemployment rate, in a very, very short term. Something like the Treasury's wage subsidy, which has been proposed, and unfortunately there's nothing in there. So I don't think it's going to change the outlook over the next 6 to 12 months.
Dennis, to what extent do you think the National Credit Act has brought in a change to the demand side of the South African economy, so that could keep interest rates low going into the future, that we won't get back to those 15–20%, but also for credit demand and for consumer spending, that you're not seeing that demand coming through?
Yeah, I think you could have a situation where interest rates can go lower than what we've been used to in the past, but at the same time you don't have an explosion in credit. But it's not just the National Credit Act. I think it's the experience of the last couple of years. It's the Basel III, both the capital as well as the liquidity requirements. All those things are going to actually impact on credit growth. And hence I think the equilibrium interest rate will be lower than what we had anticipated in the past. I mean, at a very fundamental level, you'd actually have to say that the National Credit Act shouldn't have had any impact, because all it's really saying is that you should lend to people that can pay back the money, which I would have thought would have been reasonable practice anyway.
Yeah, but
as we know.
Dennis, we have to leave it there. Thank you very much for coming in today.